In today's episode, we're going to talk about how to grow a real estate portfolio. We're going to talk about how to finance it when you get started. What criteria are you looking to make it profitable? We're going to talk about exit strategies like refinancing, BRRRR. We're also going to be talking about once you get to a certain amount of units, what team members should you be adding? And we're even going to talk about partnerships as well too, on some why it makes sense to partner, on others why it doesn't. To help us with that, we got KR with KJ Consulting. For those of you guys that don't know his story, he went from 1 unit in 2019 to over 160 units by 2025. Welcome to the podcast. How are you, Kay?
I am so excited. Thank you for having me on your platform. I'm looking forward to sharing my story and the way we think about investing at KJ Consulting.
I love it. I love it. So walk us through your first property. How did you find that? How did you finance it? And then do you still own it or did you sell it?
Okay, so first of all, I grew up in Philadelphia. My mother raised me and my 6 siblings, single parent household. We moved around about 18 times before I turned 18. So I got a real good understanding of different areas of Philadelphia. And I understood how the tenant and landlord interaction worked out. And so my stepdad, we spent a summer with him, and he planted to see that gentrification was going to take place in Philadelphia one day. And so I started to say, all right, now I'm going to get my first job. I want to make sure I buy that first property. That was in 2009. I wanted to buy a single family property and my personal name, because you can get up to 10 mortgages in your personal name. So I said, I'm going to do that instead of LLC, because when you buy properties in your personal name and for the mortgage, you actually get more down payment flexibility. Sometimes you can do NACA program, put 0% down, FHA 3.5%, or if you don't even live in a property, you can put 15% down versus 20%. So I bought that first property actually off the auction. And so I said, I'm going to buy properties that fit within my budget. So I will buy properties for $40,000 and put down 15%, which was $6,000. Now I use a credit card to fix it up. So the first 9 years, I bought single family properties and my personal name on the mortgages, because 1, you get down payment flexibility. 2, you have a lower insurance premium. 3, you actually only have to pay for taxes for your 1040 versus 2 different forms for taxes. And you also have lower closing costs. So what I did is I never sold any of the properties. What I will do is do a combination, some cash out refis and also using credit cards in order to increase the value. But primarily I live off my 9 to 5, and I just let the cash flows grow on those 9 properties, and also benefited from the other 3 factors of being a buy and hold investor. 1, you have debt pay down. 2, you have tax benefits. And 3, you have appreciation, which could be forced appreciation from fixing up and natural appreciation just with inflation. So by year 9, I had 9 rental units, and they were generating a lot of cash flow because I decided to buy my personal name versus the LLC. And then in 2019, I bought 35 rental units, tripling my portfolio, and then 105, tripling my portfolio. So I was always doing value add. I buy a property where I can spend some money to fix it up, and I also can cut some of the expenses, and then it has more value. And then what happened is I started to borrow against that equity in order to level up and buy bigger properties.
Got it. And then what changed from 2019, before 2019, to be able to grow by 35 units in 2019?
Yeah. So what I was always planning ahead of time. So I knew by year 9 or year 10, I wanted to go accelerate, step on the accelerator. Because I said I need to first build up the cash reserves, because I didn't have any partners. So I didn't come from a wealthy family. So I wanted to go into the bank and tell the bank, look, I have the 3 C's, which I consider intellectual capital, social capital, and financial capital. I understand how this business work. You see me buy these properties that were undervalued. I increased the value and I collected cash flows, and you see that I maintain to pay my mortgages on a consistent basis. And then I wanted to also let them know I understand how to work with a team. And so I leveraged my social capital, my relationships, but I understood capital, how capital work in America. And then I worked on the 3 R's. 1, build a track record. 2, I was able to build relationships. And if you do number 1 and number 2, your reputation is going to precede you. So by year 10, I was able to tell the bank, look, you've seen me do really well the past 9 years. I was very conservative. I did what was necessary. Then I did what was possible. And now you see me do the impossible. I want to borrow against my own properties in order to buy a 6-unit apartment building, a 12-unit apartment building, and a 5-unit apartment building, and also a triplex. Those are all the properties I bought in 2019, and I start buying in my LLC. And so what would happen is in 2020, I showed the bank that I knew how to put a team together and I understood how the economics work for these properties with the same strategy of saying value add, we're just going to the next level. And then that's why in 2020, I was able to buy 70 rental units because now other people who decided that, hey, look, KR know what the hell he's doing. I want to become his partner. So when I went out and did the 24-unit apartment building, I was able to get a partner for that, and my 14-unit apartment building. And so my strategy was always to level up. I was just planting the seeds and waiting for those dividends to start paying off.
Got it. Let me ask you this. Looking back, because obviously in 2009, that was like the bottom of the market. 2010, 11, and 12, prices were a lot less than they were in 2018 and 2019. Looking back at it, would you do anything differently to maybe grow a larger portfolio sooner? And if so, what would you do?
No, I actually wouldn't do anything differently because I felt as though my number one rule with investing is return of investment. So because I grew up with very poor and abject poverty, I wanted to make sure my money come back to me first, and then I focus on return on investment. So I wanted to have that foundation and that safety net because I couldn't go back to my mom or dad and say, hey, look, I need to live with you. I need help. So for me, I said, I believe things done well are done soon enough. And so I said, I'm going to do it methodically. And I said, I made a deliberate decision that I was not going to use hard money lenders. I did not want to use hard money lenders, so I've never used them. And I did not want to sell any of my property, so I've never done that. I'm not a flipper. And the other thing is, I said I did not want a partner. I said I want to become financially independent on my own with no partner. And then once I get big enough, then I'll consider being getting partners. So I definitely wanted to take my time. Some people were, hey, we could partner, we do this. I said, no, I want to learn the whole business from A to Z. And then later I'll consider to bring people on because I know I like being the managing member on all of my LLCs. So I was not willing to give up that
Well,
power. And so maybe that's just my
Well, I,
approach.
I think the reason I ask is so I kind of had a similar journey to you where I basically bought a rental property in 2010. Then I bought like another one in 2013, 14, 15, 16, 17. And then in 2019, I bought a 25 unit apartment. Then in 2020, I bought an 11 unit apartment. But in 2020, that's when I did my first burr. And I
Okay.
looked back at it and I'm like, had I in 2000 like maybe 18 is when I did I did a
18?
first hard money
Uh,
loan as well too. So
okay.
looking back at it, I look at it like, well, maybe if I would have known about hard money loans and maybe if I would have known about the burr strategy, I could have used instead of having to save the 20% down that I did on a lot of my properties, $100,000. I could have used that $100,000 over and over and continued to do the burr. And I'm happy with the portfolio that I have, and it sounds like you're very happy with what you built as well too. But I believe that had I known what I know now, I in that market, I likely would have been able to grow a lot more than what I own now, and that's the reason I was asking that question to
Oh,
see.
that makes a lot of sense. I think for me, it's about like risk tolerance. Like I knew there were hard money lenders and people will reach out to me, but I said I don't want to pay the high interest rate. My risk tolerance isn't there because if you make a mistake, it was just taking on too much risk for someone that was poor that didn't have a whole lot. So I said I'm going to just take my time and just figure this out. Like I know people that went really fast and some people took out like a hard money loan for 100 grand, and then they did things that work out, turned it to 300,000, and then they're filing for bankruptcy. So I heard too many crazy stories like that. I said I think I'm gonna take my time because, hey, my mother didn't even go to college, and we didn't even own properties and things. So I said I'm gonna just take my time. So I understand what you were saying. So I just had said I'll do the bird strategy with these small single families. I didn't even buy a triplex or a duplex until I didn't get a duplex until recently. I went from single families for 9 years, then I got a triplex.
Do you
And so I was really, really more cautious in terms of my approach. So that's the reason why I probably wasn't as aggressive as some other
do you
people.
use hard money loans now?
No, I've never used a hard money loan in my
Really?
life. This is my 16th year. I've never used hard money lending.
Got it.
Mm-mm.
Okay.
I just was able to buy really good investments where I buy a property for $20,000, $22,000, and now it's worth $190,000. I bought one that, for example, that was a property I bought in 2018. I bought a property in 2023 for $25,000. We put $50,000 in to fix it up and appraised for $191,000. So I just really take my time to try and find those investments that can hit it out the park.
Got it. Yeah, no, but that's the reason I'm asking, because I imagine that a portion of that is obviously the market has improved from 2009 basically to now. So prices have appreciated, but the way I was looking at it, like if you could have bought like 40 properties at $20,000, even if you use a hard money
Oh yeah, you
loan,
could. Yeah, you could.
even if you use a hard money loan, it would probably be scale a little bit more today.
I agree.
So, you talk about buying in your individual name, and then you talk about like also buying in an LLC at some point. Walk us through that and what the difference in the financing was whenever you made that
Oh,
change.
that's a great question. So what I always say is that in the beginning, right, if you don't have a whole lot of money, you're focused on cash flows. So for me, I decided to buy my personal name for the first like 10 properties because I wanted to take advantage of the down payment flexibility, the lower interest rate. You tend to get a lower interest rate in your personal name versus an LLC. I don't have to always put down 20% if I buy it in my personal name. There are also some programs that I did, like I didn't do the 203K loan, but they're similar to a homestead loan where you don't live in the property, but you get the financing for the rehab and also to buy the property, and it's locked in at the same rate of 6% for the next 30 years. So I took advantage of all those programs first, and then once I hit my limit and I couldn't buy any more in my personal name, but I wanted to buy more real estate, then I realized that I had to start buying as an investor in terms of the LLC, 5 units and up. When you're buying your personal name, they're focused on like your income, what your credit score is, and also what is your debt to income ratio in terms of like how much debt for the individual. But when you start to buying the LLC, they want to know, do you have experience managing a portfolio or managing property this big? Two, do you have the down payment? Because down payments are larger. So if I'm buying $100,000 property, you want me to put 20,000 down. They're also wondering if I make the pretty much hit the net worth requirement. So when I wanted to go buy a $2 million property or a $3 million property or $1 million property, and I want to be the guarantor, they're going to say, KR, do you meet that requirement outside of your personal house? So I started to position myself to say, hey, look, my net worth is pretty high. I could be the guarantor. I could be the managing member. I have enough assets. My balance sheet is strong, and I have enough experience that you guys should take a risk on me and decide to extend me that money so I can buy bigger properties.
Got it. So what do you look for in properties? I know you mentioned value add. What else do you look for? What's the criteria for KR?
So for me, I always like to find what we do is we do a macro approach where we look at the state and we got to make sure that it's landlord friendly. So we like to find states where they don't have rent control. We like to find states where we can easily enforce the lease, and so you can evict tenants that's not paying. And then once we do is we narrow it down. We start saying, okay, let me find a city where there are actually multiple employers, because if you have a city that only has one employer and that employer leaves, then you're going to be effed. So we don't want to get flat-footed. So we find a city that we think have a bunch of employees, are as close to a major city or what have you. And then what we want to do is make sure that we find 3 zip codes. We want to find 3 zip codes, and we narrow in on those 3 zip codes, and we make sure we finding properties that are around amenities. Not that far from the airport, not that far from restaurants, not that far from schools, not that far from parks and things of that nature. And then we narrow it down even more. In the beginning, I was looking for single family houses that were in the middle of the block, because if you buy in the corner of the block, it has more windows, more concrete, all those different things. So we said, all right, buy in the middle of the block. We want to make sure we have this 3 bedrooms, 1.5 bath, so we can start to figure out what the economics would be for these type of deals. Make sure on the left side of the house and the right side of the house, you don't have crack kids or drug dealers. So we're starting to really zero in the type of properties that we want. Now, when I decided to go to apartment buildings, I said, all right, I want apartment buildings where at least they have 80% occupancy, because I don't want to be like Superman and have to make sure that I can get the vacancy up from, get it down from, if it's like 10%, 20%, 50%, I got to get it up to fill this place up for occupancy. I said, no, I want to find something that's occupied 80% occupancy. And so I know that when I close, on closing day, I'm going to get prorated rent, security deposits, and I can cover the mortgage on day one. I don't want to be like the person that's talking about if there's a hope and a prayer. And I'm not the guy that want to say, oh, I think that I can find something in the bush. Or I can take what I have in my hand. I wanted to get something that was already there, that's been established, has a history, and we will buy that type of property. And now we wouldn't buy a property occupied with Section 8 because I can't go in and raise the rents immediately. Normally you have to honor those leases. Typically market rate tenants will have leases where they say, you can, if you're a new owner, you can increase the rent or tell people to leave within 30 days of things of that nature. I want more flexibility. So we're looking for properties that actually have been undermanaged, that actually have about 20% vacancy or 15 or 10, but we don't want something too risky because that's going to put me behind. So our approach is to find something that is close to, like I was saying earlier, a lot of those amenities. It looked like it is a building that's probably not going to have a whole lot of grass that we have to cut. We're thinking about all the economics. How can I add value here in terms of increasing the rent and also cutting expenses?
Got it.
So the property maybe is behind, but I think I can get money out of it.
Got it. Are you going direct to owner? Are you going on market on the MLS? How are you finding deals?
Oh, what was interesting is that when I first started, when I was really green, what we did is we found deals on the MLS. That was the way we found deals primarily. But as I said earlier, once you build a track record and you have relationships, now your reputation precedes you. So over the course of my career, the past 16 years as an investor, it has evolved from me using just the MLS to now I have brokers calling me. I have real estate agents calling me. I also have lawyers calling me and title companies calling me saying, KR, you have a 100% closing rate. Every time you go to the closing table, you close. We know you have the balance sheet, so we would like to sell to you, even if it's at a discount. So now I pretty much accept blessings from everywhere. So because, like for instance, I have my own property management business, and my nephew works for me. He had said someone in the neighborhood in Darby, PA, had said they want to sell a property. So my nephew just walked through the property and sent me a video and said, would you be interested? So now it's a lot more easier to come across deals. But I got to figure out which one I want to execute.
Got it. That makes sense. Now, do you ever look at the like after, like, do you, like a lot of flippers, and I know it doesn't sound like you flip, they look at certain formulas like, hey, look, if I can buy at 75% of value minus repairs, then I can end up burning it and getting all my capital out? Or at what percentage of market value are you buying at, or what's your main metric? Is it the 80% occupancy that you look for? Is it the return on investment, like a certain ROI that you look for?
Yep, the number one thing is return. That's a great question. I'm glad you asked that. We use a combination, but primarily it's going to be return on investment. We want to make sure that we're getting at least 10% on an annual basis for our cash on cash return. And we also look at what we think the property will be valued after we make some repairs as well. So it's a combination because we're long-term investors. If we just look at just like the after repair value, then we're in and out. But we're saying we may actually not get the highest cash flow every month, but we know for sure that we're going to get the tax benefits, we're going to get the debt pay down, and we're also going to get natural and forced appreciation over time. So we try to do a combination.
Got it. And then at some point you took on partners, right? I think you mentioned that when you bought I think it was like the 24 unit and the 14
The 24
unit.
unit. Yeah, and the 14 unit.
Why? It sounds like at the beginning you were kind of opposed to that, and then at some point something changed.
Oh, so what happened, right, is so what was fascinating was that I said, oh, I'm going to just build up my single family portfolio, then I'm going to buy all these properties in 2019 just with my own money. I don't need anybody else's money. And then I realized that, okay, I borrowed against the equity that I had in my existing portfolio. And if I wanted to get even bigger, I'm going to have to get some partners. So if I were to buy, let's say, the $2 million property, it was during the pandemic. And so they were saying, you have to put down, you would think 25%. Instead, because the bank, TD Bank was very nervous, they said 35%. So it got higher than what I expected. I said, well, I could see 400K. Now they're talking about the number got even bigger. So therefore, for me to do bigger deals under certain circumstances, I had my equity, my personal equity. I didn't have enough of my own equity, so therefore I had to start looking at or decide to keep doing smaller deals. So when I decided to be really aggressive, when people came banging on my door, I said, "All right, now I'm ready to take on one or two partners for these bigger deals."
What was your criteria from all the people that were throwing money at you throughout your whole career? What was the criteria that you would look for in a partner? And then what are the different roles that you guys have? Like, are you the operator? Is he strictly 100% the money person? How do you guys structure it?
So the way it will work is that typically I am for all of my LLCs, I am the managing member, I am the operator, I do the day to day, and my partners take on more of a passive role. So they'll have ownership of like 19% or ownership of 15% or 10%, and then I will be responsible for everything on the day to day. And they will put some financial contribution towards the deal. But I don't ask them for any insight on whether we should buy the property or how we should manage the property or how we get the most value out of the property. And so for me, I want my investor to understand that they're trusting me as their expert to run the day to day, and I would just pay them quarterly or rather or annually and send them their schedule K1. And I know that it's not two cooks in the kitchen. So I don't expect them to be like super experts pushing back off of me. I just want us to come to an agreement what is a respectable preferred return for them or what have you.
Got it. Okay, so they're basically helping out financially, and you're doing all the day to day operations. The 24 unit and the 14 unit, were those off market or on market?
Oh, off market. What's interesting is that I already own some properties in Harrisburg. And so what happened was that a property manager in the Harrisburg area knew me and had a conversation. And that's how that deal came along. The 24 unit was like a pocket listing where the broker went out to a few people before they decided to put it out in the whole world. And that's how I got that deal. What's interesting is I had bought a 12 unit in Clifton Heights, and right next door was a 5 unit, and the owner of the 5 unit had called the county to figure out my name. Just got in touch with my property manager, my brother who works with me, and said, "Hey, I want to talk to the owner." So it was never listed. So as I've gotten bigger, a lot of deals have just come word of mouth.
That's amazing. At what point did you start refinancing the properties out? Like, meaning, did it happen like closer to 2019? Did it happen as you were growing the first 9 units, or how did you fund the first nine? Was it just, hey, 15% down, saving from the 9 to 5?
So it was more creative. So some of them, so for instance, for the $40,000 property I had bought, I put 15% down, came up with the 6,000, and then I used like a credit card, and then I would do a cash out refi for that one. Then I have so much cash that I can go buy something for $22,000 for cash. And then I was able to pay off the old credit card. So it was a combination. So I didn't have to use all of the 9 properties. I didn't have to cash out. I didn't have to do a cash out refi for everyone. But a few of them I definitely did because it gave me more flexibility. So it's trying to be more dynamic. So the way I look at risk management is like, say for instance, you have 10 properties. You don't necessarily have to have leverage on every property. You could have 80%. So what was interesting is that for when I was saying 15% down, so that means I could have 85% LTV on a couple of properties, and then I can have 2 properties free and clear to like balance out the risk.
Yeah. What are your thoughts on private lenders? Not hard money lenders, but private lenders. Have you ever used private lenders to help you either buy a property and then refinance them out?
Oh, well, actually, I have used a private lender, so it will be like a debt investor. So some people are very how we talked about earlier about the risk tolerance. So they'll say, "KR, I do not want any equity risk. I just want you to give me a nice return, whether that's 7% or what have you. I just want the debt. I just want to benefit from like if I'm holding a certificate deposit." And I would do that for 1 year or 2 years. So yes, I have done that. So someone would say, "Hey, look, I just want to be really conservative. I just want to get a nice return. That's higher than what I can get at the traditional bank at the CD, which probably was like 3%. They say, give me double, and I'll work with you. But I don't want to take on any more risk."
Yeah, and to be honest, I did that recently, maybe like 2 years ago, and that's like one of those things that like remember when I said that, hey, look, had I known, or let me ask you this, at what point did you use your first private lender?
The first time I used a private lender probably was in
Yeah.
2019.
So this is one of those things that I did it maybe like in the last 2 years. And when I did
Okay.
that, I was like, man, like I really wish I would have known that back in 2010. Had I known that people would like a fixed return without
Yep.
taking on
They don't
any
want
equity or anything
equity.
like that,
They just want a nice return. They like, don't give me any
not
risk.
only
That is true.
not only that,
If you
yeah.
definitely, if you have the risk tolerance, yes, you can definitely take on as many as you
Well,
want. I was just being kind of safe and saying, I don't want any extra stress. I don't really know what I'm doing
yeah.
navigating these waters. But after doing it for 10 years, then I felt more comfortable like taking other people money and writing stuff up and working with lawyers. But before I was kind of nervous. I said, I don't know. I don't know.
Well, I kind of did the same thing where I use all of my money. It's almost like our journeys are very similar, where I use all of my money to buy the portfolio. And then as I started growing in like 2020, I got involved in a mastermind. It's called Collective Genius. That mastermind's got like 200, like maybe like 400 of the top investors around the country. And I started learning different things. Like one of them was private lenders. I started learning about the BRRRR strategy, and I started just learning
Mm-hmm.
different things. I'm like, man, like had I known some of these things, or if I'm giving somebody else advice, now we're able to get more creative, and there isn't a need to wait 10, 15 years as long as you find good opportunities, or as long as there's properties that make sense, basically.
Mm-hmm. I agree. I agree.
Yeah.
Yeah, I was like, I'm going to take my time, and a lot of my friends were actually saying, "You, oh my goodness, KR, why are you moving so slow? I thought you said you knew this real estate thing, man. Who takes 9 years to get the 9 properties?" I said, "Look, trust me, I got a plan, but I don't want this thing blowing up in my face."
No, and it's similar to me where I did the same thing as well too, and I felt like I took the time to learn it. Obviously, retrospect, like nobody knew that the market was going to double or even triple in price in some markets. But like looking back at it, I'm like, man, like that's one of those things that had I known the BRRRR, had I known private lending, had I known hard money lenders as a whole, I think that it could have gone a lot better. And don't get me wrong, like I'm happy with the portfolio that we have. It's just there was some really amazing opportunities back in the day, like unbelievable.
But do you think you had the risk tolerance for it, the stomach for
I,
it,
I I
or
I did. I just didn't have the knowledge.
the knowledge? Oh, see, I knew the knowledge. I just didn't have the risk tolerance. I
So
said, no,
so I
thank you.
was the opposite. I had the risk tolerance. I just didn't have the knowledge. Like I had no idea about a BRRRR strategy. Zero idea. Or let me ask you this, like at what point did you learn the BRRRR strategy? Did you know the BRRRR strategy back in 2009, 10, 11, 12?
And 2009, 2010, 11, yep,
Okay.
yep. But because I came from nothing, right? So like my sister was murdered, my by the father of her 3 children. My brother was, when I went off to Bloomington College, my brother went off to prison for attempted murder, and so all these different things just made me very cautious about taking on way too much risk.
Yeah.
Even though I was being exposed to it, I actually worked for a hedge fund and I was analyzing home builders or what have you. I worked at Goldman Sachs, so I was exposed to different things, but I was like, nah, I
So
can't be taking no risks. I just want to land on my
So
feet.
what I did is I bought as much as I could with the money from my income. Like meaning from the money from my job as a real estate agent, I bought as many. So I have no regrets because I bought as much as I could with my money. But like I put like in one year I put like two or $300,000 in down payment. Had I instead done a BRRRR strategy, that $200-300 I could have kept turning it and just buying more and more and more, and I was making enough income where I qualified for loans as well too. So,
Yeah.
but I didn't know about the BRRRR. I didn't know about hard money lenders. I didn't know about private lenders either. And now that I know that, I'm like, okay, like now we're able to. So, what I realized is when I was having to put 20% down, it starved my business and it kept my business smaller than it could have been because I depleted a lot of the capital that you can use to grow the business in down payments for a property, which was good. At the same time, it starved the business. So had I been able to be like, okay, like, so as my strategies changed, it wasn't just about how do I maximize cash flow, it's how do I buy the
Yeah.
deals that cash flow, but with as little money out of pocket, or how do I get my money out of the deal faster so that I can go back and do it again? And once I learned that, that's when it started to grow a lot faster because I was able to use the same money to make more money basically at that point.
Now do you have partners, or you just still do everything by
No,
yourself?
so me and my wife own 37 units in California, um, no partners, and then we own 20
Yeah.
units with my dad, my sister,
Okay.
an
Yep.
additional 20. So together it's like 57 units in California, which the
Wow.
price points are a little
Yes.
bit different. Yeah,
Higher.
a
Yes.
little bit different.
Yeah.
Like the 25 unit cost 4.4 million, and that was just me and
Yes.
my wife.
Yeah.
But it was kind of like a very similar journey where now I feel like I'm a more sophisticated investor, like understanding subject to transactions,
Yeah.
understanding
Yeah.
creative finance deals, which I didn't know a lot of that at the very beginning of our career, basically.
Yeah, and what's so interesting is that I actually could have bought another. The year that I had went from 9 to 35 rental units, if I wasn't so stubborn, I could have bought another 9 unit. I missed out on it. It was a 9 unit for. They wanted 735,000. I was being stubborn. I said 715,000. Either take it or leave it. And now when I go by that neighborhood, drive by, it's like 1.5, and that was in 2019. I said, why was I fighting over $15,000? It's so stupid. So yeah, you just it's just that. And another property I had bought that was in the neighborhood, it was like for 40,000. I said, I'm not get. They wanted 50. I said, I'm not giving you no 50. I said, I'm sticking at 40. I'm sticking at 40. Now that property is worth 280,000. So you always have those moments where, like, should I have been more aggressive, or could I wanted to be able to sleep at night, so
Yeah,
I just said,
it sounds like your approach is was a little bit more conservative in approach, which is good. Obviously, like now you're able to grow that, and now obviously you have more um, information. So, what advice would you give to somebody looking to grow like their real estate portfolio?
So I personally still believe in the same process where prior to the Great Recession, you could only buy 4 properties and get a mortgage in your personal name. And now they changed it to 10 properties that you can get in your personal name using a mortgage because they were trying to stimulate the economy, the government. So I always tell people start that way because I feel as though if you get a lot of reps, you build up your confidence, then you can step on the accelerator and you can really buy a lot, and you can also people want to invest with you. Like I have someone now calling me saying, "KR, can we do a deal? I'll give you $250,000. We can start a new LLC. I want to be your partner." So for me, I would say start small and build out that confidence, and also build up those relationships with lenders and that reputation, and then you'll be in a position where you can own the majority of your portfolio and start to scale. And for me, I had said, look, I want to start my own property management business as well. So I want to be able to keep that money because sometimes the property manager can make more money than the landlord off of each property. So I had said, let me start to really build up my skill set. And so you have to figure out, do I want to be a real estate agent? Do I just want to be an investor? Do I want to be a property manager? And then you can make a lot of money because the riches are in the niches. So I said, I'm going to figure out these markets where the purchase price is low and the cash flows can be high. And I also have the laws in my favor to enforce my leases.
Got it. So, what do you do now to bring income? Do you live strictly um, off the rental,
Rental income.
or is
Yep,
it
yep.
mainly the consulting business that brings the income? And do you have a
No,
license or a property management company?
I have a real estate license, but I've never worked on any of my deals. I convince family members to get their real estate license so they can get the commission. So when I buy something for $1 million, my brother's my agent, he gets a 3% commission. And I did start KR2 management, property management, because I had said, look, why would I pay somebody like in Philly? If you got a single family, you can pay 10 to 12%. If you got an apartment building, it could be 5 to 7%. And then all the other fees. So I said, we're going to bring that in house, and I'll just hire subcontract various family members to work for me, and also some friends. And so that's the route I decided to take. I live primarily off of my rental income. And the reason I can do that, and I was telling people, is that even those 10 properties that I still own, I've never sold any of my properties, never used hard money lending, I've never flipped any of my properties. I have those 10 properties, they have mortgages for 30-year fix, and I refinanced them in 2020. Their mortgage, the interest rate is like 3.1%, 3.2%. So even though those houses are being rented out for $1,600, the mortgage is only like 300, 400, 500. And I'm not talking about the property tax or insurance included, just the mortgage. And so that is really sustainable. I said, figure out what your number is that you feel comfortable, whether that is 10,000, 20,000 every month, and then you can start to build on top of that. So the consulting business is secondary. The real estate business is where I make my bread and butter, with the property management and also just being an owner and owning a large percentage of the portfolio. What some people do is they do syndication, and they'll say I own 1,000 units, but I only own 1%, and so they can't live off of it. But if you own like 100 units or 200 units and you own 80% or 75% or 90%, those cash flows are going to come back to you directly.
Yeah. Yeah, exactly. So why not flip?
So the reason I don't like to flip is because flipping is not necessary. I didn't leave my full-time job to do a second full-time job. Flipping requires you to keep coming up with ideas, to keep looking for something new. Otherwise, when that dries up, you have no money to rely on. I don't want to be required to look for a new idea to flip and pull permits and do all this crazy stuff when I can just say I'm gonna buy something, fix it up once, rent it out, put people on 2 to 3 year leases, and just have reoccurring money and just do cash out refis and not pay taxes whenever I need to take money out of the property. Versus when you do a flip, you're primarily going to pay a higher tax rate, because you're not owning a property for a year, and you're also going to have the headache of dealing with the city or the county trying to get permits and contractors. When I do easy breezy cover girl houses, rehabs, where we go into the property and what we're going to do is do the kitchen over, we do the bathroom over, probably put some hardwood floors in, recessed lights. We're in and out within like maybe a week or two at the most, and now we're ready to go on to the next project where I'm not tying up so much capital.
Got it. I love it. So let's say somebody's looking to buy properties with little to no money down. What advice would you give them?
So that's the other reason why I tell people, if you want to really start with no money down and you don't own a bunch of properties in your personal name, I always tell people go that route, because if you are a veteran, you could put 0% down. If you're a doctor, they have programs. Lawyers, you put 0% down. They have the VA program. They have a NACA program where you're going to not have to put any money down. You have no closing costs. You can get grants. You could buy 1 to 4 units to get your feet wet. I would say go that route. You also could buy a property where you don't even live in it. You could put 15% down, like how I talked about. I bought $40,000 properties, or I bought a portfolio, $185,000 with 5 single families in Harrisburg. So what I would say is that you want to take advantage of that. So that's using traditional financing. Then you could do non-traditional financing, what we call creative financing, where therefore you could basically use a credit card and take money off of the credit card, and that could be your down payment for that property. Or sometimes you could take enough money off the credit card if you have good credit and a nice limit and buy the entire property. Like I bought a property for $22,000 or $25,000, and you could take that money and buy a property. The other realm you can use is how you talked about earlier, where you're using like private lenders or debt investors who say, I'll give you $50,000 for 2 years, pretty much like a CD. You give me 6%, 7%. Do whatever you want. You buy the property, you fix it up, you can refi, cash out, refi, pay the person off. The other route is you can decide that if you want to get partners. And that route is if you decide to get equity partners. They give you some funding, you manage the property, and you say, I'm going to exchange my expertise, and you provide me with the funding. And the other route is you can decide to use a combination of what I all talked about. We're using credit cards, personal money, and you get money from hard money lenders, and you buy property and rehab it, and was able to pay off the hard money lender. So there are a number of ways you can skin a cat. You have to figure out where do you feel comfortable so you can run your own race at your own pace.
I love it. I love it. Now, what are the big? I know you said you had some friends that maybe didn't do the same way that you did it, and maybe you saw them kind of like go through bankruptcy or kind of like do things that they shouldn't be doing. Let me ask you this: like, what mistakes do you typically, or did those people make? And what advice would you give to somebody that maybe is considering something like that?
So some of my friends, what the mistakes they made is that they were growing too fast. They were moving, like you always hit the saying, oh yeah, success like speed. Go ahead, fly the plane. You didn't even make the plane up as you're going along. No, that's very dangerous. That's nice in theory, but some of my friends didn't know what they were doing, and they took out a hard money loan for one house. Let's say 100,000. They got robbed from contractors. they didn't wind up selling that property until they were $280,000 in debt from the hard money lender.
Damn. That's
So
crazy.
you got to be very, very careful about who you're working with. So with my contractors, I looked at their license. I got their picture of their ID. I took a picture of their tags. I said, I need your emergency contact information. I need to talk to 3 or 4 references in person because you get to and look into work. So I was very, very cautious. Some of my friends, they were not. Some people actually, what they were doing is they will buy 5 or 6 properties at the same time, and they're buying in the most they're buying the most dilapidated properties in the most dangerous neighborhoods where no one actually will want to live and nobody actually would want to buy from them if they had to sell the property. So therefore they got stuck. And so they're in a situation where they have to pay off these loans. They can't pay the loans off. They can't rent it out, and they can't sell it. So therefore their back is up against the wall and they have to file for like bankruptcy because they quit. A lot of them quit their jobs after they got 1 property or 2 properties. They hit 1 home run. They're like, oh, this is good. They're like, I said, nope. That's why I decided to keep working until 2020 because I said, look, I started working in 2005. I need to build up a nice cash cushion so I can feel comfortable. So those were some of the mistakes that people made. They were going too fast or spreading themselves too thin, and they were risking everything. They didn't have. I always tell people, plan for the worst and hope for the best. Have a base case scenario, have a worst case scenario, and a best case scenario. So they didn't think about the probability or the chances of things going wrong.
I
And
love
they
it.
also, some of them got into bad partnerships where they didn't even know the person, didn't even do any background work, didn't even see if their personality is going to match well, and they just got really effed over.
Damn, I'm sorry to hear that for them. Okay, cool. So let's say that somebody's enjoyed this episode and they want to get in contact with you. What's the best way for them to do that?
So the best way to reach us is at KJ Consulting, KAYJAYCONSULTING on Instagram. Also, you can follow us on TikTok. You also can check out our website, which is kjconsulting.net. And we go live every Tuesday at 7 p.m. Eastern Time, teaching a brand new subject absolutely free on real estate.
I love it. Cool, man. Well, I want to say thank you for taking the time to be on the podcast. Today we had KR with KJ Consulting. He talked about how to grow a real estate portfolio. We talked about how he grew from 9 units, from 1 unit in 2009 to 160 plus by 2025. We talked about how to finance them, what you look for, exits, refinances, private money lenders, hard money lenders. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful, make sure to hit that share button. Thank you again, KJ, and to our viewers, until next time.